couple years ago, I bought a house for $650,000 using a 15% down payment vacation home loan. This particular house had a huge pool and it was fully furnished. Later, when I did my taxes, I was shocked to see that the tax savings from buying that house was actually greater than the down payment that we made. In other words, the IRS literally made the down payment on this house for me. My name's Kate Lynch, and about 5 years ago, I decided to use real estate to get out of my corporate job and have more time with my family. And over the last 5 years, I've learned a lot about how to maximize the returns you can get from the funds you have available to invest and get incredible returns from real estate. If you're interested in learning more about how you can get the IRS to make a down payment on a home for you, click the like button and follow along on our journey as we talk about real estate strategies that can create financial freedom for you. There are a number of details to this particular strategy that you have to get right in order to make it work. First of all, you can only get the benefit of this depreciation when you have active investments that have losses that you can use to offset active income. If you have a high-income job where you're paying more than $100,000 a year in taxes and you invest in an Airbnb property that counts as an active investment, you can use the depreciation losses from your Airbnb investment in order to offset your W-2 income. A lot of people think you need to be a real estate professional in order to use your real estate losses to offset active income. But the IRS considers an Airbnb to be an active investment as long as you're managing yourself. This won't work if you hire somebody else to manage the property for you. But as I've talked about in some of my other videos, managing an Airbnb doesn't have to take a lot of your time if you set it up with the right systems. The second criteria that made this work for us was that we used a vacation home loan with a 15% down payment in order to buy the house. In theory, you could also do this with a 20% down payment, but it will be harder to cover your full down payment with depreciable losses if you have a higher down payment. I'll add that it's perfectly legal to rent a vacation home on Airbnb as long as you're disclosing that to your lender when you're buying the house. This is not like the situation we've heard recently in the news about people who are buying more than one primary home in different areas in the same year. As long as you plan to use this home for personal use at least part of the year, and you're disclosing to the lender that you're also going to rent the house part of the year, this is a perfectly legal strategy. Now, the crux of this strategy relies on the bonus depreciation that's available under Trump's big, beautiful bill. Back in 2021, when we bought this house, we were able to get what's called bonus depreciation for 100% of the value of any assets that had a 15-year or less useful life. Before we bought the house, I hadn't spent much time thinking about what the useful life was of the various aspects of the houses that we bought. But this was the first time that we bought a house that had a pool. In this particular case, the house had a huge pool and it also had beautiful landscaping. It was on about 30 acres of land, but it was in a really remote part of Ohio where the local land values were relatively low relative to the value of the house. The way depreciation works on a property like this is you take the purchase price of the house and then you allocate that value to different pieces of the house. Some portion of it will be allocated to the land, and that land value is not depreciable. So the lower the land value relative to the purchase price of the house, the easier the strategy will be. Adding a pool to the house creates tremendous opportunity for depreciation, in particular a pool like this one, which ultimately in our cost segregation study was allocated more than $100,000 of value. Because the pool has a useful life that's 15 years or less, you can deduct 100% of the value of that pool in the first year that you buy the house. In this case, we also happen to be buying the house from a couple who was downsizing, and we asked them to leave a lot of their furniture in the house. They were comfortable doing that, and they had really beautiful furniture. They left behind both the inside furniture and their pool furniture, so that ultimately we were able to allocate around $50,000 worth of value to the furnishings that we acquired. We also were able to allocate around $50,000 to the landscaping on the house. It had a couple huge patios and some outdoor seating areas. It had a gazebo and a lot of other outdoor features, including a couple of ponds. It was a gorgeous property that we felt really lucky to buy. But when it was time to do the cost segregation study, I was amazed to find how much value was allocated to those outdoor features on the property. On the inside of the house, you also allocate the purchase price to different aspects of the house. Things like carpets and appliances fall into the 15-year bucket, and if you get enough of the value allocated to those, it can also boost the amount of depreciable property in the house. So all in for this house, we had a little more than $100,000 allocated to the swimming pool, about $50,000 allocated to the landscaping, another $50,000 or so allocated to the furniture, and about $50,000 of the purchase price was allocated to the interior components of the house that have a less than 15-year useful life. For less than $1,000, we were able to get a cost segregation study done by an internet-based company that does these remotely, where you provide all the details of the house and they do the allocations for you. So the total of all those depreciable items that we got from that study was more than $250,000. Because we were in a high tax bracket, our combined federal and state income tax was around 45%. This meant that we were able to reduce our tax bill by about $112,000 on a house where our down payment was around $100,000. The fourth thing to keep in mind is that this is not permanent tax savings. I actually like to think of it as if the IRS had given us an interest-free loan for the life that we owned the property to cover the down payment on the house. I hear a lot of people in real estate talk about how long it takes to save up a down payment on a house. But if you're in a high-paying job where you're paying more than $100,000 a year in taxes, you can use this strategy to shift your dollars. Instead of paying the IRS that $100,000, you use that money as a down payment and take the depreciation so that you reduce your tax burden. And you don't have to pay that $100,000 back to the IRS until the time when you sell the home. I think this is one of the most powerful strategies that anybody can use to invest in real estate if you're in a high-paying job. And don't forget that after we finished all this, the house actually generated $40,000 to $50,000 a year of profit for us. If you want to try to figure out if you can do this as well, feel free to reach out to me, and I'd be happy to help you see if you can use real estate strategies like we did in order to create financial freedom and have more time to spend with your family and doing the things that you love.